That's about how long it takes for the price of something to change somewhere in the world. Gas, groceries, rent, stocks. You think businesses decide those prices, or supply and demand, or maybe greedy CEOs. But there's a hidden machine running in the background, and it quietly decides the price of almost everything. You don't see it, you don't vote for it, but it shapes your life every single day. Right now, people feel like everything is more expensive, even when headlines say inflation is cooling, even when the economy is strong. Something feels off. Paychecks stretch less, homes feel unreachable, markets swing wildly on a single sentence from a central banker. That's not random. There's a system underneath the economy, a kind of financial engine room, and when it speeds up or slows down, prices everywhere start moving. Let's walk into that engine room. At the center of the machine is one thing: money creation. Most people imagine money as something the government prints and hands out, physical cash, bills rolling off a press. In reality, most money is created when banks make loans. When you take out a mortgage, the bank doesn't transfer someone else's savings into your account. It creates new money digitally with a few keystrokes. Your loan becomes a deposit. New purchasing power appears. Multiply that by millions of loans, mortgages, business credit, car loans, corporate bonds, and you don't just have more debt, you have more money circulating in the system. And when the amount of money grows faster than the amount of goods and services, prices rise. That's the first gear in the hidden machine. But there's a second gear, and it's more powerful: interest rates. Think of interest rates as the speed control dial. When central banks lower rates, borrowing becomes cheaper, loans surge, companies expand, investors take bigger risks, asset prices climb, housing booms, startups multiply, money moves faster. When rates rise, the opposite happens. Loans slow, risk shrinks, asset prices wobble, growth cools. Every time a central bank adjusts rates by 0.25%, trillions of dollars react. That's why markets hang on every word from the Federal Reserve or the European Central Bank. Not because it's dramatic, but because the cost of money determines the price of everything built on money, which is everything. Let's make it concrete. Imagine interest rates are near zero, mortgages are cheap, a family can suddenly afford a bigger house, investors can borrow cheaply to buy property, developers can finance new projects easily, more buyers chase the same number of homes, prices rise. Now raise rates sharply, monthly mortgage payments jump, buyers disappear, investors back off, developers pause, prices stall or fall. Same houses, same neighborhoods, different cost of money. That's the machine at work. And it doesn't stop at housing. Stocks are priced based on future profits, but future profits are discounted by interest rates. When interest rates are low, future earnings look more valuable today. Stock prices rise. When rates climb, those same future profits are worth less in today's dollars. Stocks drop. Nothing about the company may have changed, just the discount rate. Even government budgets run through this machine. When rates are low, governments can borrow cheaply. Debt feels manageable. Spending expands. Stimulus flows. When rates rise, interest payments explode. Suddenly, deficits matter again. The machine tightens. Now here's where it gets uncomfortable. The system requires constant credit expansion to keep growing smoothly. Modern economies are built on debt: household debt, corporate debt, government debt. Debt isn't just a side effect, it's fuel. If credit stops expanding, growth slows. If growth slows, defaults rise. If defaults rise, banks pull back, and the machine grinds down.
So policymakers walk a tightrope. Too much credit expansion? Inflation, bubbles, asset mania. Too little? Recession, unemployment, panic. There's no stable off position. And here's the irony. When the machine runs hot, asset owners benefit first. Stocks rise, real estate climbs, financial assets inflate. If you already own assets, your net worth grows. If you don't, prices move further out of reach. Cheap money makes everything feel more expensive, not because goods changed, but because purchasing power shifted. Then, when inflation finally becomes visible, at the grocery store, at the gas pump, central banks slam the brakes. Rates spike, markets shake, layoffs begin. The same machine that inflated asset prices now squeezes the real economy. It's not personal, it's mechanical, and it's global. Because the US dollar sits at the center of the world's financial system. Global trade, commodity pricing, sovereign debt, much of it is tied to the dollar. When US rates rise, dollars become more attractive. Capital flows toward America. Other currencies weaken. Countries that borrowed in dollars face higher repayment costs. A rate decision in Washington can destabilize a housing market in Toronto, a startup ecosystem in India, or a government budget in Argentina. That's how interconnected the machine is. But here's what most people misunderstand. This isn't a secret conspiracy. There's no villain in a control room pulling a single lever. It's a system designed decades ago to manage crises and smooth economic cycles. Over time, it grew larger, more complex, more dependent on constant intervention. Every crisis since the 1980s reinforced the same pattern. Lower rates, inject liquidity, stabilize markets. It worked, until it didn't. In 2008, the machine nearly collapsed under its own leverage. Central banks responded with zero rates and massive asset purchases. Then came a pandemic, even more money creation, even lower rates. Asset prices surged, wealth gaps widened, inflation eventually followed. And suddenly, the machine had to reverse direction, fast. The speed of that reversal shocked markets. Bond prices fell, tech stocks tumbled, banks cracked, governments felt pressure. All because the cost of money changed. So when you look at rising rent or falling stocks or layoffs in one sector and record profits in another, don't just ask what's happening. Ask what is the cost of money right now? Is credit expanding or contracting? Is liquidity flowing or draining? That's the hidden machine. It doesn't announce itself loudly. It hums in the background, in balance sheets, in bond yields, in lending standards. And it quietly decides what your paycheck can buy, what your home is worth, whether startups boom or disappear. The uncomfortable truth is that most people experience the output of this system, prices, not because goods changed, but because purchasing power shifted. And here's the question that lingers. If the modern economy can't grow without expanding debt, and debt becomes dangerous when it grows too fast, what happens when the machine reaches its limits? Does it evolve? Reset? Or simply demand an even bigger intervention next time? Because whether we understand it or not, whether we agree with it or not, the machine is still running, and it's still deciding the price of everything.